Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is May 6th of 2024, the first update of the month of May, and we have a lot to talk about. The stock market remains in a corrective process as we bounce between major support as well as major overhang resistance. And we continue to trade along that channel. So we don't want to, part of the message this week is that, we're not in a rush. And I think it's important to remain patient and use corrections to our advantage. One of the biggest things that a correction can provide to us is some evidence or clues as to where the market may be going next in terms of major themes. One of the things that we look for in a correction are what are the areas of the market that are actually holding up pretty well, that are not recession-proof sectors? And is that a sign of a change of leadership, a reacceleration of leadership? And what are the specific companies leading the charge? So we're going to go through all of that this week. The title of this week's presentation is Investing Against the Crowd. When we think of long-term investing and where we get some of the more attractive forward returns, is certainly from being in areas of the market that have attractive valuations, but also that aren't super crowded. And at some point may become crowded, right? Sort of this idea of skating to where we think the puck is going to be in the future. So there's going to be three key areas that we're going to focus on this week. That market correction, we know that process remains underway. Technology continues to wobble. We want to focus on the relative strength of that sector. What is it trying to tell us about the average technology stock and what that leadership looks like right now? And then lastly, China continues to break out across the board. I cannot think of a more contrarian investment on the planet right now than Chinese stocks, emerging market stocks. When we think of the real estate market there, this idea that the real estate market is falling apart, the economy is falling apart, the stocks are telling us something else. The market is trying to tap us on the shoulder and say, actually, something else is happening. And maybe we don't exactly know what it is, but really great companies over there that are trading at dirt cheap valuations, they're starting to break out. And I think it's time to pay attention. So when we think of the market, we talked a little bit about how that market is trading, how the S&P 500 is trading right between major support and overhead resistance. Obviously, Friday was a really good day in the market. Tuesday, Wednesday, not so great in the market. So what do we look for during that correction? Well, the percentage of stocks at 20-day lows. Right now, that's sitting at about 17% because the market has bounced. So the question is, will the percentage of stocks hitting 20-day lows hit lower lows or higher highs, right? So what we want to understand is this correction near the end, or is this correction still got some more work to do, right? So if we hit a lower low or a higher high, pardon me, that could mean, hey, you know what? There's probably some more selling to do before we finally clear up some of the supply in the market. Credit markets, what are credit markets doing, right? And we're going to go through that later on in this presentation. And of course, what's working in a tough tape. Under the hood, we talked a little bit about technology here at the front end. But if we can see here, technology relative to the S&P 500, when we think of the equal weight index. So every stock in the tech sector that has when we look at it with an equal weight. So in other words, Amazon, or not Amazon, pardon me, that's a bad example. But if we think of something like NVIDIA, it has the same weight as something as Analog Devices, right? Versus on the cap weight index, as we see here on the right, NVIDIA would represent a far greater weight because of its $2 trillion market cap versus Analog Devices, which is like a $150 billion market cap company. Actually might be smaller than that, but you get the point. So the key here is that both types of sectors, right? So the technology sector equal weight and the technology sector cap weighted, where the bigger companies represent a bigger share, are both breaking down relative to the S&P 500. So not only are they lower in price, but they're going down more than the S&P 500. Same with the cap weight. Not only is it going down in price, but it's going down more than the S&P 500. On those bounces in the market, it's going up, but it's not going up as much as the S&P 500, which is distinctly different than how technology has been behaving in 2000 or behaved back in 2023, where it went up more than the S&P 500, went down less than the S&P 500. That's a change in symptom. It's a change in behavior. And it's something that we need to make sure that we are tracking and we understand, is this a temporary condition or something more structural? And we look at Microsoft as a great example of this, right? So great quarter. There was nothing really bad about Microsoft's quarter. They came in with great earnings, great revenue, great guidance, clean stock, right? At the center of AI. But guess what? It's crowded, it's expensive, and it's consensus. So when we look at the buy, holds, and sells, 64 analysts are buys, 5 are holds, and 0 sells. That is the epitome of consensus. And when we see something like that, and we see the expensive valuation, and we get that tangible feel that it's certainly crowded and people want to buy it regardless of what the price is, it's a yellow to red flag for us to say, hey, great company, but may not be a great stock in the future. And when we think of what might be working in technology, well, we talked about this last week, right? Where Chinese technology names are similar in terms of their platform capabilities, dominate their domestic market, but the valuations are significantly lower, right? So Chinese technology companies as a whole trade under 15 times earnings versus close to 30 times earnings for the US tech group. We believe that this gap is going to close, and that represents an advantage for Chinese technology names relative to US tech names. Doesn't say anything about what we feel for them as companies. Doesn't mean anything about the fundamentals. We just think that there's a catch-up trade with Chinese tech relative to US tech. And we can see that as the S&P 500 has pulled back, we see here, this is the Hang Seng. So this is the Hong Kong market, obviously dominated by a lot of Chinese tech platform names such as Alibaba or JD or Tencent. You can go through down the laundry list of names that represent a big chunk of the Hang Seng index. But for the first time since 2020, these stocks are breaking out of a 4-year downtrend. We think this is one of the major themes of 2024. We have repositioned the portfolios to reflect that view. I understand that there are political concerns around that, and we can address those for individual clients. But this is the trade, in our opinion, for 2024. Some of the best companies, if you can separate the idea of China versus US for a second, some of the best run companies dominate this index and are trading at recession level valuations. And so we just think that this represents some of the best and most attractive bargains on the planet right now. And it's not just in technology. So this index here, this is the Hang Seng Materials Index. So this would include like copper names and certain chemical names. And what this is telling us is that if there was a recession in China, no one has told the commodity sector, no one has told the industrial sector or the materials sector, because these names are also breaking out. And they're the most recession sensitive types of companies out there. When we think now, pivoting back to the US, and we think of the credit markets, is this correction going to be something deeper, long lasting, or is it more of a traditional just correction working off an overbought condition? Credit markets right now continue to tell us that the evidence suggests that this is more of a correction working off an overbought condition, letting stocks catch their breath. Because if it was something more structural, economic in nature, bank related as it relates to credit, you would see these credit spreads widening as we did leading up to COVID, right? So this is your COVID time period, cost of credit spikes. Today, nothing, right? Your cost of credit has remained absolutely firm. And this is during a time where rates are backing back up due to inflation concerns. So the fact that this is happening in the interest rate backdrop during a market correction tells us that evidence suggests, again, not guaranteed, that we should be out there trying to buy attractive merchandise out there in the market. The one sector that has started to weaken a little bit is oil. We are overweight energy. So how have we responded? Well, first of all, what's causing the oil weakness? There is a lot of chatter out there that there could be a U.S.-Saudi deal as it relates to Israel. U.S. may potentially provide the Saudis a formal security agreement. In other words, a formal military alliance with the Saudis. If that happens, one has to question whether there's quid pro quo in the background of the Saudis increasing oil production in return for that. So what's our potential game plan? Well, we want to pay attention to the symptoms. Oil has been breaking down. The names have held in relatively well. So what we're doing is we're reducing our E&P exposure, exploration and production company exposure, while maintaining our service weight. Because as production goes up, what we want to actually see, or what we want to do, is increase our exposure to the U.S. service names because their utilization rates are going up. And we saw that with earnings this week with a company like Tidewater, which hit a 52-week high. And we only bring that up because they're a major service name in the energy space. So in summary, that healthy consolidation continues. The S&P 500 is trading between that support and resistance zone. Bottom line, ladies and gentlemen, we can be patient. Second, the relative strength across technology names continues to weaken. We think that's a red flag. What's our play on this is we're just avoiding technology for now. And if it breaks down, then great. We can buy some really great AI companies or some great tech companies at bargain prices later on in the future. Lastly, the one area that is acting quite well are China and emerging markets. That's where we've gone overweight, along with commodity exposure. And that's where we remain overweight as of the beginning of this week. So that's what we got for you this week, 888-543-3776. Please feel free to give us a call or give your advisor a ring, and we'll be happy to help. Thank you again, and have a great week.